We're going to start our session with a conversation with Karthee Madasamy, founder and managing partner of Mobile Foundation Ventures. Karthee, welcome to the show.
Thank you, Sramana. How are you? Glad to be here.
Great. Well, let's get you introduced to our audience. Tell us a bit about your background, a bit about Mobile Foundation Ventures, and let's situate the context of this call, of this conversation.
Sure thing. So we are a $75 million early stage venture fund, Series A focus, a post-seed Series A focus, and we invest in deep tech. The phrase is a little bit odd, but what we look at is we look at tech differentiated companies that have tech as a primary differentiation factor. So we look at Series A companies that are trying to disrupt traditional industries like automotive, manufacturing, agriculture, some of these services as well, using tech as a primary way to enable the disruption. And so we started last year. We've done about 7 investments. Done about 7 investments so far. As background, before this, I spent 11 plus years at Qualcomm Ventures. I was a managing director there. In addition to investing in the US, I started the office for Qualcomm Ventures in Israel, India, and we started exploring in Southeast Asia as well at the time. Before that, I spent 10 plus years doing startups in Silicon Valley in the mid-90s. I come from a technology background, electrical engineering. The funny thing was 24 years ago, the master's thesis that we were doing was in AI, but it was just not a proven tech at the time. It's just funny how things come back in a circle with good computing power now, and then a few more breakthroughs. Now AI is just applied everywhere, but at that time it was still underperforming. But anyway,
yeah,
so
I completely resonate with you. In the late 90s, mid to late 90s, I was doing AI companies. It was too early. And I remember this journalist, Malik, who was a friend of mine, he was making fun of me because I was doing AI. And it's like, now AI is all the rage.
Exactly. Okay. I think the technology has come along as well, but anyway,
Yeah, timing is everything. So let's talk a bit about the kinds of companies you are investing in and the stage at which you like to come in. So you've talked about deep tech. Is it all B2B, deep tech in the context of B2B, or do you also do B2C?
I think it's primarily B2B. I think it's not doesn't have to be necessarily B2B, but it's largely B2B. I mean, the example that I would give is that at Qualcomm Ventures, I invested in Waze, even though it is a B2C application, if you will, but there's fundamental technology behind it to create maps on the fly and create traffic patterns and things like that. So we would look at, in our current fund, some B2C companies that have a significant technology element as a differentiator. But it's largely, I think I would say 90% plus would be probably B2B tech.
Yeah. And stage, what do you like to see in companies before you're willing to write a check?
Yeah, so we look at post-seed to Series A is where we look at, and I think there is a gap in Series A, I would say. We're definitely seeing that there is enough, there's a lot of seed stage funds who are writing smaller checks, so first $2 to $3 million can get filled by enough venture funds out here. At the same time, there are enough bigger funds writing larger checks in later rounds and whatnot. I think the way we see the gap, especially for deep tech or tech differentiated businesses, Series A, because these are companies that need larger amount of capital. They are at a stage where they need larger amount of capital, whether it's $5 to $15 million. They have some early product market fit, but they still have ways to go. So that's where our focus is. So we don't invest in more concepts or PowerPoint slides and things like that, but we look at companies that have at least got into a product, got into early customer discussions. So early product market fit is what we're looking for. Sometimes they have revenues. So if it's largely software IP related companies, even at a Series A stage, they have some revenues. Sometimes in full stack, which is hardware plus software, they have more NRE revenues or early customer traction pilots, but not necessarily repetitive revenues yet. And then there are some very hard tech like some semiconductor modules and things like that where they may be pre-revenue. So we don't look at revenue as an indicator, but what we look for is companies that have taken few steps to the product, and then there's some early product market fit, and we're looking to raise between 5 and 15, which basically means they've crossed the seed stage, if you will. And that's where we look at it. And that's where we also see the gap today in the market globally, but I think we focus largely in the United States, so North America, and we definitely see that as a gap, especially for deep tech companies.
And what size checks do you write?
So right now we write between 1 and 3 million, where we may go up to maybe 4 million check when we go in, and then we keep about 1-to-1 reserve for follow-on rounds. So ideally between $5 and $7 million we keep for per company. This again depends on the company. And then we can lead around, for example, a small Series A, $7-8 million Series A, we can actually lead around. Some larger Series A will actually follow the other lead syndicate type of things. We can do either.
But if it's a 1 million check, you can do that yourself.
Right.
Yeah, great. We will have probably stuff to talk about soon.
Sure. Yeah.
So let's, as the next segment of the conversation, let's kind of double-click down on your portfolio and talk about some companies that you've invested in that you feel good about, and help us think through or help us understand what drew you to those companies. How did they find you, or how did you find them? And what did you see in them when they came to you? What did you see in them that made you want to invest in them?
Sure.
So
sure.
a couple of
Yeah, sure thing. So we've done about 6 investments, closing on our 7th investment as well. So I'll talk about maybe a couple of companies so that it gives a flavor of the type of things that we invest in. So the one company that I'll talk about is 20 Billion Neurons, which is a Toronto and Berlin-based company. What they do is they do computer vision for action recognition real time at the edge. I think image recognition has become almost like a table stake today. But when we were looking at it, we thought that doing something on the video is much more complex than doing anything on the image, and going beyond just the object recognition is an important factor we felt in terms of understanding common sense, understanding high-level context, which is where we are going towards more and more towards. It's not just recognizing some patterns, but it's also recognizing high-level context. So it was a high-level thesis that we had because we had done image recognition companies in the past, and how things have moved to the point where that is now table stake. But I think still complex stuff is not being recognized easily by an automated machine. So we were looking for that type of companies. So 20 Billion is actually founded by students of Jeff Hinton, who's a Turing Award winner, the father of modern AI. So these guys have built a technology which can actually recognize very complex actions at real time at the edge itself. So that was when we first got introduced through another investor or through another partner. We were looking at the space, and we hadn't seen actually too many companies in the space. It was a much complex problem. We actually very quickly grown attached to that. Okay, let's try to understand this more. And in terms of finding companies, I think a lot of it comes through our network, which for an entrepreneur, that's one of the things that we'll push as well, is that use your network. And but anyway, this got introduced through a partner, and so we started evaluating them. So the thing that we liked was the key way they are differentiating in terms of technology to get this thing done. That we have not seen before. And then second, the technology was very robust in terms of how well they performed. So we compared that to other companies that we had seen or other technologies that we had seen. We really like the technology. And the third thing is the entrepreneurs themselves. So there was definitely a willingness to understand how to take this technology and then go after market. There's definitely the willingness to engage in a discussion, engage in a conversation to figure out, push and pull. I think that's one of the important things at the earlier stage
What
companies. Yeah.
what application did they tell you they were going to go after as they started approaching you and you were evaluating them for investments? It's kind of horizontal technology, but I imagine you looked for an application to zero in on, yeah?
Yeah, that's right. So there were a few areas that this could apply. There was obviously anything that has a complex process that needs to be recognized. This technology could be applied. So they had applications around anything with actions, which could be around any human-machine interaction in automotive, anything on retail, anything around health, anything around the process in manufacturing. So there's a bunch of different applications. So the two applications that they went after were one is around retail, where there's human-machine interaction, and the second was around health and fitness, where how do you understand a complex exercise routine that you are doing type of a thing. So those are the two applications that they went after. Yeah, so I think in some other cases where you're looking at technology companies, that's the key thing to bridge, like where can this be applied. And we had a few vertical focus where we could validate some of these applications as well. I think we kind of focused around retail and manufacturing and health as some of the verticals that this could be applied, and they've been progressing on that ever since.
And how big was the investment?
So this was a $10 million round that M2L, Microsoft's venture fund, us, and Coperion, which is a German fund, all three of us invested. So it's a $10 million Series A. It is a prototypical round that we do. This is a company that already had like 15 people, and they had early customer success in terms of deployment. Not necessarily like recurring revenue type of a thing, but at least early customer adoption. And a sizable round where the company needs this capital to actually grow and build.
Karthee, one question that arises from this discussion that I would like to explore for the benefit of our audience is how do you view long sales cycle enterprise deals? Because it sounds like the kinds of technologies that you like the most are these deep technologies catering to large enterprise customers where there is typically a long sales cycle. So, if you're doing little deals, you can get into some amount of recurring revenue quickly. You can start showing some MRR statistics, etc., quickly. But if you're really talking about very large enterprise deals, often that is not the case. The product takes some time to build, and you can get validation through, pain point endorsement from enterprises, but not yet quite, checked. Well, how do you deal with these situations?
Yeah, so I mean, I think it's a very good question. It's a very interesting point as well in terms of, especially as an early stage investor, how are you looking at this? We actually look for technologies that are solving significant problems. I think that's the first place we start with. So we look for companies that are trying to solve big problems. So when that happens, first of all, what we have seen is that there is a natural pulling from the enterprise themselves because they are also trying to solve this. So they're looking actively for companies like that. It interests them quite a bit. It doesn't go into the traditional arguments around, okay, how much does this incrementally help us type of a thing. It goes into this fundamentally changes our business. So we look for those things, so that helps a little bit into the early conversations. But we also look for entrepreneurs. We also look for teams that understand this thing and then have the ability to maneuver this a little bit more. So we kind of balance those two. So in most of the investments that we have done or we evaluate, there's already a pull from some of the enterprises because they're trying to solve this as well. So they're trying to understand this. They're looking for partners. They're looking for solutions as well. So that reduces the cycle a little bit. But it is a active discussion that we have in terms of how do we look at these companies. So many of them have 3 to 9 months of sales cycle. And the good thing about some of these things is also the early reference account helps quite a bit. So it doesn't have to be a 3 to 9 month cycle every time. So we look
Right.
for things like
As your
how are we,
reference accounts build up.
yeah, yeah. So we look for those things, and then in some cases there are customers who actually want to move really fast, where the sales cycle is much faster as well. So it's able to get the team to figure out some of these things, like go after some of these things to get a quick adoption and use that as a reference to. But I think the larger point about large enterprises taking longer sales cycle is definitely there. I think you try to solve this in several smaller ways, uh, and I think the main one would be solving a very huge problem for an enterprise where the value proposition itself doesn't need to be sold very aggressively. It's understood. It's just the point of how to integrate and how do you
Yeah.
get that.
Okay. So I think the bottom line, what I'm hearing is that you're quite open to these kinds of situations and you understand the complexity of the selling and so forth, and you're willing to work with the entrepreneurs, which is good. Because there's a set of investors who are using these MRR, ARR benchmarks, and they want to see $1 million annual revenue run rate before they want to write the checks. And that's for certain companies that, especially since you're doing deep tech takes investment to build a product and to get to any MRR whatsoever. So it's it's not so easy to show those numbers.
That's right. Yeah, it is a process. It is a cycle. The one thing about some of the products in deep tech would be that you've seen this as well. There's quite a bit of investment up front, but then when there really is an adoption, you see much faster upside as well. We have seen companies that go from $1 million annual revenue to $30 million, which is not uncommon once the product market fit is there, because it's a product.
Right. And some of these deep tech problems, if they're solving a big problem that has lots of ROI, they're big deals. You could have $1 million deal, and as you say, with 30 customers, you're at $30 million, and then you don't need much financing. These kinds of deals, once you hit your stride, these types of businesses don't need much money to build.
Right. I think there's an upfront investment, but once the fit is there, a lot of these things actually don't require as much investments, and it is, as we look in the last 10 years, software companies actually raising more money than some of the deep tech companies, because the cost of sales is still higher. So some of the software as a service startups still keep raising money, large amounts of money, which because they need to continue to acquire customers and they need to deploy capital to acquire them.
So this is a good segue into my last set of questions that I want to explore with you, which is the tension that we face in the industry between this hyper funding, too much funding, flushing companies with capital, blitzscaling, blah, 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 versus building more fundamentals-oriented, capital-efficient companies. Where do you sit in this debate? So
there is never a one-size-fits-all. That is one of the learnings being in the early stage ecosystem for 25 plus years, is that there is never a rule. There is never a rule of thumb. So for certain companies or certain areas, maybe the high capital will garner the market makes sense. But I think it's also a learning, and I think it's true as well, is that innovation cannot be driven primarily through capital. Because if that has been the case, these would have been taken, Silicon Valley would have been taken out by capital providers long time ago. Right?
Yeah.
I don't believe that fundamentally. Obviously, there are sectors and there are segments where capital can provide good acceleration and then get that market going, but in a lot of other areas, capital doesn't provide that, because market innovation can only take in so much capital. So I actually don't want to call it as a generalization, but outside of a very few areas, this concept of throwing capital to get that hyper growth does not work. And which is probably what we are learning in the last 5 years as well, because probably outside of certain areas, this did not actually work. And we actually fundamentally believe in fundamental breakthroughs which require capital but cannot be. It's not in lieu of innovation. You can just use capital to go there, right? So I think there's a little bit of that correction happening actively at this point. There are still certain areas where this could still apply. where there's largely it's like operations-driven, enabled by technology, where maybe capital can help. But many of these other areas, we do not think that is the way this will work. And some of the things that we're seeing that as well very very quickly. Actually, this whole capital-driven thing started out like maybe 5-6 years ago. Already, people are seeing that doesn't work in all the cases, or most of the cases, it does not work. So we actually believe that innovation needs to be driven. Capital plays an important part, but it cannot be in lieu of just pumping capital.
Yeah, good. So we are definitely on sync on that. Okay, so that gives us a good understanding of Mobile Foundation Ventures. And folks, Karthee will be staying on for the entrepreneur pitches, so you can ask questions later on in the program. That was very helpful to discuss the large enterprise-facing businesses that are working on deep technology, which is an area where we do quite a bit of work. We have a lot of companies that are working in this mode, and they all have the kinds of issues that we discussed. So this will be a valuable insight for them.